So let's focus on accounting adjustments for a moment. Companies make, as they go through their business, they record transactions, but some transactions don't necessarily happen by themselves. Usually a transaction is triggered when the company receives cash or when they pay cash. But sometimes transactions happen, the companies have expenses or revenues without actually receiving or paying any cash. So for example, your employees might have worked all month long and you haven't paid them. So you had an expense and you had a liability. And you normally wouldn't record that until you actually pay for the expense. But sometimes you have to record that in order to make your financial statements accurate. So not recording it would be excluding a legitimate expense and also a liability. That would be wrong. So you have to record these adjustments in order to get your financial statements right. And there are 4 kinds of accounting adjustments. What's called prepaid expenses, unearned revenues, accrued expenses, and accrued revenues. Those are the 4 types. Let's go through each one. Let's say you paid $200 in cash in advance for advertising. So initially what you would do is you would credit cash because you're paying cash for $200, and you would debit prepaid advertising for $200. Here's the adjusting journal entry. Let's say that you used up $50 worth of those ads. So what you would have to do is you'd have to take $50 out of non-cash assets and increase your expenses. Now, how would this keep your accounting equation in balance? The increase in expenses would reduce retained earnings. So your asset would go down by $50, and your retained earnings would also go down by $50. Another example is unearned revenues. Let's say you receive $400 in cash in advance from a customer, but you haven't yet delivered the product. In this case, it's an iPod. Okay, so you get $400 in cash, 400 cash increases, but the unearned revenue liability is also going to increase because now you owe a customer $400 worth of stuff. So let's say you deliver the product to the customer. So now you can take the $400 out of liabilities and put it into revenues. So that's going to increase your income by $400 because revenues and sales have increased by $400, and therefore retained earnings is going to also increase by $400. But what also happened is an iPod that cost $150 is no longer in stock. So what you've got to do is you got to take the $150 out of inventory. You would subtract that from the asset, and you'd also record cost of goods sold for $150. That's a second type of accounting adjustment. A third type of accounting adjustment is what's called accrued expenses. This would be a situation where you have an expense but you haven't yet paid for it yet. Well, you have an expense but you haven't yet paid for it yet. So you have, let's say, wage expense and wages payable. By the income statement, you would record a $100 wage expense and you would book a $100 liability for wages payable. Then, when you pay the cash, as you pay your employees, you take the $100 out of the liability over here and you take it out of cash because you're paying it off. And the third one is accrued revenues. This is where you earn revenue but you haven't yet collected the money. So let's say you sell an iPod, $500 worth of iPods. So you would credit revenues and you'd also debit accounts receivable for $500 because now you've earned the money, you've delivered the goods, and your customer owes you $500. Now, it doesn't show you this on this entry, but when you collect the money, you would credit or reduce accounts receivable by $500 and debit cash for $500. And the inventory, you've sold inventory now, so you got to take the inventory off the books. So you would credit accounts receivable for $400 and you would debit cost of goods sold for $400.